Amnish Aggarwal, Head of Research at Prabhudas Lilladher, joins in now to help us with the markets and overall, how to approach stocks. Amnish, good morning and thanks for joining in. Motilal Oswal released a report this morning on PSU Banks where they spoke about how, despite the rally, they're still bullish on PSU Banks because the earnings quality is improving and valuations remain attractive. Would you agree with this viewpoint?
Good morning, Sonia. The main thing is that in this point, there is, I would say, nothing which is new. It is already well known that whether you look at the NPAs, whether you look at their, you can say, growth rates or balance sheet, the PSU banks have improved significantly over the past couple of years. And at the current situation where most of the private banks are trading still at maybe, say, at least 1.5 to 2 times the price to book of PSU banks. So that makes PSU banks still, they are looking quite attractive. More so, I think after a rally in the second run stocks, I think the frontline PSU banks are the ones which should catch up in terms of, say, market action and you can see improvement in the price to book values.
Okay, all right. Amnish, what about the tech space? Kotak has come out with a note today. They are saying that, yes, the Fed's dovish comments were good, and that's what pushed the IT stocks up. But it appears, it's a little bit too optimistic. And that's why they've downgraded a couple of names out there, Persistent as well as HCL Tech. What's your view on tech and which are the stocks that you like?
See, the main thing is, as far as your Fed commentary is concerned, I think one should not expect any rate cuts to happen, maybe at least for the next couple of quarters. And given the fact that the entire IT services space in India is glued to what happens in the US as well as in the European market, so the stocks had a rally. And one big reason for that was that these stocks have been significant underperformers over the last 12 to 18 months. Now, given that backdrop, I think in the sharp rally which we had seen, whether it was the TCS, LTTS, LTI and all these stocks, I think some sort of a pause can't be ruled out. But yes, if you take a slightly longer term viewpoint, if there is no hard landing in the US market, then tech spend should be back, which should push the growth rate higher, more so from FY25. I think given this backdrop and I think particularly the stocks like, for example, Infi, TCS in the front lines, LTI, Mindtree and LTTS are the stocks which should look good, particularly after the listing of Tata Technologies, which has listed at quite a significant premium to LTTS. LTTS is in a very sharp rally over the last, say, you can say fortnight or so. And I think this entire space is going to be having some action, but intermittent reactions from time to time can't be ruled out because the actual translation to earnings as well as you can see improvement in profitability, that might be at least a couple of quarters away.
Amnish, the big talking point is the start of rate cuts in 2024, right? Both from the US Fed and perhaps the RBI following suit as well. All these rate sensitives, whether it's real estate, NBFCs, auto stocks, do you see more upsides? And if yes, which is the pocket that you're that you have the most conviction on now?
Okay, you see, as far as your interest rates are concerned, there's a fair bit of probability that from the post, say, June next year, we might see some action on that front. So with respect to that, obviously, I think financial will be the ones which will definitely be in the limelight, whether these are banks or your NBFCs, they are on one hand. On the other hand, if you look at, say, the second pack, which is real estate, I think real estate could get a leg up from this because the EMI costs actually go down and the affordability of that goes up. The third one which you talked about is autos. I think my sense is that autos, we have seen now the momentum actually being there, both in terms of, say, your commercial vehicles as well as PVs from quite some time. And two-wheelers are just catching up. I think if the rate cuts happen, it will be more beneficial for the two-wheelers because that market has not been going from the past couple of years, followed by, say, PVs and your commercial vehicles. Now, as far as investment is concerned, I think all these sectors, they have been doing well. So particularly if you are looking at autos, I think still your PVs, it makes sense to buy select, you can say PV stocks like your Maruti is there. And maybe you can say in two-wheelers, one can look at, say, maybe a Hero at the current juncture because the demand revival actually happens. So similarly, I think banks and real estate also, yes, we will selectively get stocks from these which can actually outperform. But if the rate cuts happen, there will be, I would say, a broad-based, you can say, uptick in all these sectors.
Got it. Amnish, any thoughts on Z? You know, there's a story this morning talking about how things are looking a little precarious. Z's asked for an extension, whether Sony will agree to it, not. Deadline is nearing. Seems like a bit of a binary situation. What would you advise those who are holding on? And there have been many who actually bought in the hope that this will culminate and valuations will re-rate.
I think the entire Z story was, you can say, banking upon that ultimately the merger will happen, more funds will come, you will have a, you can say, new MNC parent, and so the overall level of corporate governance and transparency in the company will improve. So if the merger doesn't go through, definitely it is going to be negative for the stock as well as for the shareholders, at least in the medium term. Because the entire sector is in some sort of, I would say it's in a big transformation stage, where on one hand you have got an aggressive Geo, and then we are having Disney Hotstar. And plus the way your OTT market is actually shaping up, it is very difficult for any player with, you can say, any weak positioning in that market or even in the overall context to be making money in the longer term. So in the near term, I think it is a very catch-22 kind of a situation. And definitely there could be, you can say, some near-term correction in the stock price if the merger definitely doesn't go through. So for the holders, I think I would say very difficult actually to give a call, because it's an event-led kind of a situation. But if the stock, say, moves up from there, then one can look at, say, booking some profit. Okay, because the near-term uncertainty is there. But if the merger actually goes through, then definitely there could be, you can say, some reasonable gains on the table over the next 3 to 4 months.
Okay, all right, Amnish, always good hearing your thoughts. Thanks for joining in and filling us in with your take on a whole host of stocks as well as sectors.